This is Bloomberg Markets. I'm John Ehrlichman with Kriti Gupta. And Kriti, as we were discussing at the top of the half-hour mark, at the top of the next hour, we're going to be getting those minutes from the recent Fed decision on interest rates. And patiently waiting with us here is Dana Peterson, chief economist at the Conference Board. Dana, thanks for joining us again. You talked about watching for any clues on how aggressive the key members of the Fed will be. But I know at the Conference Board as well, you have been measuring confidence among CEOs and how they feel about issues such as a recession right now. What kind of data points can you share with our audience?
Absolutely. Our survey of CEOs published last week showed that 57% of them anticipate that inflation will slow over the course of this next year, but that there will be a recession, a brief and shallow recession, but a recession nonetheless. And that's pretty much tied to many of the events that we're seeing abroad, but also monetary policy. And even though they think that the Fed is going to be aggressive, they also anticipate that the Fed will come back and help calm things down if we do go into recession. So, you know, hiking, I can interpret that as hiking above 3% and cutting rates. Alternatively, the Fed may just pause after several rate hikes to see where we are. But certainly businesses are many of them are convinced that we are headed for a recession either later this year or next year.
Dana, what does that mean for the balance sheet?
Well, I think for the balance sheet and just even for Fed policy in general, the Fed has signaled that it's willing to do whatever it takes to arrest inflation, to wrangle it to the ground. However, the chair has said, look, we want a soft to softish landing, but certainly that leaves open the possibility of recession. In terms of the balance sheet, I think the balance sheet action really has very few implications for the real economy. And indeed, even Chair Powell suggested that some people are saying that dialing back down the size of the balance sheet is equivalent to about a 25 basis point rate hike. So there's really not much going on there. But I think, you know, interest rate hikes will certainly calm consumer spending. We're already hearing consumers saying that they're delaying purchases in the face of rising interest rates. And certainly if inflation remains elevated, even with the Fed's actions, consumers are saying they're buying cheaper goods, they're looking for discounts, and they're even driving less.
Dana Peterson of the Conference Board, we thank you as always. Let's get a quick check on these markets here ahead of the FOMC minutes that we were just talking to Dana about. John, we are seeing some marginal gains in the S&P 500, up about 0.2%. John, I wonder how much of this is a wait-and-see approach for what we're going to get at 2 o'clock.
And obviously, we also have to wait and see what happens with a lot of other economies around the world. We had seen those comments out of China today as well. So you're right. We are seeing a little bit of buying ahead of those Fed minutes, particularly in hard-hit technology stocks. We'll have all those details coming up next. And obviously, we'll watch the market reaction to all of that. For Kriti Gupta, I'm John Ehrlichman. This is Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Breaking news. We are but moments away from the Fed minutes release. This is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
I'm Taylor Riggs.
And, well, we're keeping an eye here on the markets, of course, as we wait this. Keep in mind, all the major indices actually open lower here on the day. It looked like it was going to be a pretty dour start up to the day, but all of them have managed to spend a good portion of the day in the green. The S&P higher, as is the NASDAQ. The Russell, your outperformer on the day, up about 1% right now. The Dow Jones Industrial Average, though, that's been deep in the red for a good portion of the day. Now, let's go out to our very own Michael McKee, who's standing by with the Fed Minutes. Mike, what do you got?
Well, there are no surprises in this set of minutes, Romaine. At their May 4th meeting, Fed officials saw a strong economy with extremely tight labor markets and very high inflation, well above their 2% target. That justified a 0.5 percentage point move in their benchmark interest rate. And while they anticipated that growth and employment would stave off any significant downturn, most participants, this is a quote, judged that 50 basis point increases in their target range would likely be appropriate at the next couple of meetings. Now, they have all told us that since the last meeting. The economic outlook is, quote, highly uncertain, they said. And they also noted that a, quote, restrictive stance of policy may well be appropriate. That might be a slightly dovish consideration. In this note, risk management considerations would be important going forward, and many participants judged that expediting the removal of policy accommodation would leave the committee well positioned later this year to assess the effects of policy firming and the extent to which economic developments warranted policy adjustments. Remember, just on Monday, Atlanta Fed President Raphael Bostic suggested that maybe they want to pause in the fall. That part might support that. Yeah. In spite of slow growth in the first quarter, policymakers felt GDP would grow solidly. In the current quarter, still China's fight with COVID and the Russian invasion of Ukraine were particular risks both for inflation and supply chains. Although some noted that supply chain problems might be easing, the majority were still felt they were significant, and some business contacts were telling them they were reluctant to expand or had canceled construction projects because of supply problems. Substantial increases in wages and input prices were being passed into higher consumer prices, the members felt, and in some cases hurting sales. There were also some concerns expressed about the tightening and the reduction of the balance sheet impact on Treasury liquidity and problems with risk in commodity markets given Russia's invasion. But the thing that really stands out in these minutes is that there was extraordinary agreement on almost every point. You know, many times we talk about few, some, several. Not much of that in this. There was general agreement on the outlook and on the policy.
And the fact, of course, that Fed Chair Jay Powell had said, look, 75 basis points isn't on the agenda and no discussion of larger rate hikes overall. Talk to us about the Treasury market liquidity. Talk to us about quantitative tightening and how that could, as they say, perhaps have unanticipated consequences. Any sort of feed through on what we might see in terms of when we start to get that balance sheet runoff?
Now, just a little bit of concern expressed because, of course, what happened in 2018-19 when the Treasury, when they were rolling down the balance sheet the last time when we got to the 2019 September and the Fed had to back off of its rate increases because liquidity was drying up. But now they've put in the reverse repo facility and dealers can get cash from the Fed in exchange for securities. So they think they can deal with that. But there are always, as you say, unintended consequences.
Mike. It is great to have you on the ground there to give us the latest and the greatest from the Fed Minutes. Michael McKee, we leave you there. We thank you. Ethan Harris, I'm pleased to say, is with us for even more analysis. Bank of America, head of global economic research. Much consensus from the minutes, it would seem, and a methodical move higher, of course. Potentially restrictive policy may become appropriate. Ethan, from your perspective, more hawkish, more dovish than we were anticipating?
No, I think it's what you would expect. I mean, the Fed's finally admitted that they're behind the curve and they have to catch up. And so doing 350 basis point hikes in a row is kind of the bare minimum. That gets them to the very low end of what might be a neutral funds rate of 2%. I think it's not that low, but that gets them at least within the neighborhood of neutral. And so there's no disagreement in the committee. They got to get moving here. So it's not a big surprise. The real question is going to come later when we get into the fall and when they decide whether to slow down or pause.
and we talk about getting to neutral, maybe restrictive territory. Does that happen by year end, or do you think it happens significantly before year end? And then, of course, getting to that pause that you just discussed.
I think there's been a lot of wishful thinking about how low neutral might be. Let's think about where the Fed is going here. It's going to be very hard for them to get inflation back down to 2%. I don't think it's even possible in this cycle. So inflation's going to end up next year being close to 3 rather than 2. And so the neutral rate can't be lower than inflation. That would be very surprising. So I think the neutral rate is at least 3%. I think that if they do pause in the fall to kind of reassess, they're going to end up going right back to hiking rates. And so I think by early next year, they'll move beyond 3, and we ultimately have them going to 3.25 to 3.5.
Does that assume, Ethan, that economic conditions, at least as we know them today, sort of continue at the current pace? Does that take into account the potential for a downturn?
Well, I think the Fed has to risk a downturn. They've let things run out of control. I mean, there are two inflation problems, right? There's a supply chain problem, which is largely out of their control and hopefully will resolve itself. And then there's the, the overheating labor market. That requires a higher unemployment rate. And if you're going to raise the unemployment rate, you're going to risk a recession. So I don't think there's an easy option for the Fed here. And they do have to really slow the economy down. We don't have a recession in our forecast, but a high risk of recession.
Notable. Of course, we see them upgrading their outlook for PCE. We're about to get that number as well, Ethan. Overall, do you think the soft landing you feel is perhaps attainable if we're going to avoid some sort of recession? But what do you make of the balances and how the market takes it? Do you think that in any way the Federal Reserve will start to look at the sell-off and blink in any way? And do you anticipate any sort of pause come September as the door has been cracked open a little bit by Raphael Bostic?
Yeah, so I think that the sell-off in the markets is kind of what you'd expect. I mean, you can't slow the economy down by magic. You have to tighten financial conditions. So at this stage, we haven't seen panic. We've seen pretty ugly markets. I mean, we're all sitting there watching our screens getting depressed. We've seen a pretty big rise in rates. But, you have to withstand some pain. So I think that the threshold to get the Fed to stop here is pretty low on the equity market. Once you get further out and there's actual evidence that you're cooling off the job market and you actually do see the unemployment rate start to rise a bit and you do see some progress in inflation, then the Fed can be a little bit more gentle on the brakes. But right now they're way behind the curve. There's no evidence that they have inflation anywhere close to under control. And so we have to not count on the Fed here to rescue us until we get further out in the year.
That sort of leads us to the headline of your latest research note. There's a lot of stag and there's a lot of inflation. How are you thinking about the dirty word that is stagflation?
Well, I mean, there's no really good outcome here. I mean, we're not going to get a soft landing in the sense that we need a rise in the unemployment rate. The labor market is too hot. It's not even close. I mean, you have almost 2 job openings for every unemployed person. You have to get the unemployment rate up, however painful that is. The Fed waited 6 months too long to hike interest rates. So when you're in that kind of environment where the Fed's fighting inflation, you're either going to get very weak growth or a recession. And on the other side of the equation, it takes time to bring inflation down. So stagflation is almost a certainty at this point.
Almost a certainty here. Do you think, though, the Fed has the commitment, or you think that they will sort of see this through? Because even if we get to a stage here where, they need to either act faster or, I guess, continue the hiking cycle for a lengthier period of time, the idea that there's going to be pushback, not only from the economic indicators, but pushback from financial markets as well, do you think they're willing enough to stand up in the face of that?
Yeah, I think that I think the threshold for the Fed is the following. They know they have to get the unemployment rate up, so that has to happen. They can't accept 3% or wherever the unemployment is going to keep dropping here. They can't accept that as a permanent condition, and they need to see some progress on inflation, at least down to 3%. At that point, they can declare a victory.
Down there, the April new home sales, a buyer's strike, whether that's mortgage rates or whether that's just being priced out the market. But what about these other areas of still frothiness that we haven't seen yet resolutely popped?
Yeah, I think it takes time to cool things off. You've got a big shortage of home for sale, so we're going to see a sequence of softening. First, the drying up of refinancing. Who wants to refinance at these rates? Then a cooling off of home sales. People don't want to move if they have to take out a new mortgage. And then eventually slower production and slower prices. So I think it's going to take a bit of time to cool housing off. Sorry about the throat here. I'm all choked up about this economy right now.
Emotional. No worries. Thank you for hanging in there with us. Final quick question here, Ethan, if we can. I want to bring this full circle and kind of end where we started, which is peak inflation. I'm hearing actually more and more notes today that actually maybe peak inflation isn't behind us, and maybe more importantly, the level at which we sort of taper out at. And I know at the beginning of the conversation, you were talking about how we may not even get to 2%, maybe 3% inflation this cycle. Where do you see sort of the leveling off of inflation, if that's more important than how we're looking at peak inflation?
Well, I mean, right now, there are hints that we're peaking out at extraordinarily high levels. Now, because of the disruptions in China and because the recent oil price spikes and so on, it's delaying the fall in inflation. But I'm pretty confident that over the course of the second half of the year, we'll see a steady drop in inflation. The question isn't, is it going to drop, though? It's what does it drop to? Mm-hmm. And there, I look at the consensus, and people have inflation coming all the way back down to 2.2% in 2024 without putting into their forecast a really bad economy. I'm sorry, how does that happen? You've got too much, you've got a red hot labor market, wage growth's not going away. Half of the inflation problem is going to stick here. So you got to pick your poison. If you think you're going to get inflation down, you have to pencil in a recession or near recession. If you think that Fed's going to tolerate a little bit of inflation, maybe 3% inflation, then maybe you don't need to pencil in a recession.
All right, Ethan, going to have to leave it there. Great to catch up with you. Ethan Harris, Bank of America, Head of Global Economic Research, helping kick off today's program, of course, with a look at those Fed minutes coming up. We're going to take a look at all those annual meetings going on out there right now. Twitter shareholders had their annual meeting. There was an elephant in the room, and, well, they pushed it right out of the room and ignored it. We'll have the latest on that in just a moment. Plus, we're going to talk about a whole lot more, including maker of Sam Adams beer getting into the cannabis market. Caroline, the head of cannabis, Paul Weaver, over at Boston Beer, going to be joining us, and China's premier, talking about the economy and saying that things over there right now, well, they're potentially worse than where they were in 2020. We're going to take a closer look at China's economic challenges. All that and more coming up in a bit. This is Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
season continues.
Shares were down 92%. Stock up 20%.
The shares, they've been all over the place.
Bloomberg breaks the numbers first.
Netflix is losing customers in 3 out of 4 of its regions.
Disney Plus dodges the streaming slump.
With exclusive expert analysis.
You've got to parse each and every company.
Commodities, a sea of green. No wonder we got inflation on our minds.
To see this outperformance compared to Netflix,
it's surpassing pre-pandemic levels.
Bloomberg Television and Radio, the fastest numbers and analysis you trust.
Twitter's annual shareholder meeting just wrapping up. Joining us now for our Stock of the Hour, and of course the latest out of that meeting, our very own Ed Ludlow joining us from San Francisco. Ed, your key takeaways.
Yeah, the first being that Egan Durbin, who's a partner at Silver Lake, did not get enough votes to be re-elected to the board. That's important because you'll remember we found out recently through filings that Mr. Durbin was one of the key characters in Musk's early considerations of building up a stake and buying the company. You'll also remember that Mr. Durbin and Silver Lake played a pretty key role in Musk's attempt to take Tesla private in 2018. So he's not around on the board now. He didn't get the votes. We did get a mention of Musk's bid, although it wasn't on the official agenda. Arjuna Capital, through Natasha Lamb, had wedged a proposal to have somebody added to the board that had a greater level of expertise in human and civil rights. I'm paraphrasing, but her argument was that if Twitter had had a good track record on human and civil rights, they'd have a good track record on freedom of expression. And if that were the case, then they wouldn't be subject to one of the biggest take-private deals of all time. She was unimpressed with the idea that Musk buying Twitter was a protection of freedom of speech. And I'm paraphrasing again, but she ended and concluded her remarks by saying minting or crowning another media mogul is not the right answer to improve the problems which at this point are well stated on the platform.
Let's just move across town very briefly, Ed, because we've just had the Meta Investor Day conclude as well. And a greatly read story today is how they're pivoting really to Reels and might change it up, basically copying TikTok to a large extent. But where do they see Reels going? And indeed, a loss of a key member of the board there as well.
Yeah, I think, the main takeaways across town or 50 miles down in Palo Alto area is that Reels is going to be really important, right? This battleground for video has been such a key story. And now when we see the sell-off in social media stocks linked to concerns around the macro picture and advertising, video becomes more of a micro focus. Of course, the other big news is Peter Thiel stepping down from the board. That had been announced in February, but, part of the process of these AGMs is rubber stamping things that we knew, and Peter Thiel now out of the picture at Meta, and he'd been such a confidant and advisor to Mark Zuckerberg. That's an interesting point. And finally, Carrot reminds me that as of today, Jack Dorsey officially is also off the board at Twitter, and it's the first time in the company's history where a founder is either not an executive or on the management team or on the board. So times are changing.
Yeah, times definitely. About the future of this company, whether it's going to be a future in the hands of Elon Musk or a future in the hands of, well, who knows? Angelo Zeno joining us right now, CFRA Senior Industry Analyst. There he is. Angelo, so great to have you here on the program. Let's start off here with what the future holds for Twitter, specifically when it comes to the company's fundamentals. We can set aside the Elon Musk show for now. This is a company that still has pretty decent revenue growth, though the user growth certainly leaves a lot to be desired. And we all know some of the challenges it has with regards to profitability and the monetization of those users. Do you see a future, a better future for Twitter ahead?
Well, listen, I think the best case scenario continues to be an exit strategy here, and that is kind of, shareholders approving any sort of deal at a higher level than the stock is trading at today. But that being said, as far as the kind of the fundamentals are concerned, I mean, we just heard Snap, yesterday or, a day and a half ago, come out with kind of some of the near-term outlook of their company and the sharp deceleration we've seen from the fundamentals just from April to May. And that's a significantly better growth story than Twitter is. So when we kind of think about Twitter, we think about the daily active users there. We think about the business model there and the potential profitability, maybe to your point here, over the next 3 to 5 years. And you kind of look at what Musk has said, or kind of some of the targets he's thrown out there, some very aggressive targets in terms of getting to north of 600 million users by 2025, north of 900 million by 2028. We don't think there's any real way of hitting those type of targets. So at this point in time, we think on a standalone basis, this is a company that's still worth $26 at best. And after kind of some of the declines we saw yesterday, probably worth significantly less than that.
So are you, well, not to use the word discounting, but how are you thinking then about a deal that gets done, if at all, at $54.20, or are you significantly discounting that to a more reasonable price?
So, about a week and a half ago, we did lower our target price to about we lowered it to $44 a share. And, we do think when you kind of think about the standalone, at least at that point, the standalone value plus, what we think is the most likely scenario, and that being kind of a lower revised target, we think kind of the low to mid $40 level is the most likely exit strategy at this point and revised target. At the end of the day, just given what Musk has kind of gone through already, given the fact that he has obtained that financing, we do think that the most likely scenario continues to be an acquisition, of Twitter by Elon Musk.
Briefly, Angelo, we of course see Jack Dorsey leave the board, now no founder on it. What do you make of the board's role in all of this? They're steering from a corporate governance perspective.
Yeah, I mean, listen, I think as far as the board is concerned, I mean, they just haven't kind of lived up to expectations here, and hopefully they kind of get this all right at the end of the day. But we have very little faith as far as the board is concerned on a number of different, topics. But, as far as kind of, this is concerned here and the deal, I think, the board really needs to make the right decision here and get as much as they possibly can for shareholders.
Angelo Zeno, great to have some time with you. As always, CFRA senior analyst on all things Twitter. Meanwhile, coming up, a little bit more Elon Musk, but this is his space venture. SpaceX gearing up for another launch, another Falcon 9 rocket. More on that next. This is Bloomberg.
Subscribe to Bloomberg, you won't just get news, you will get insight into limitless possibilities. Before you change the world, Bloomberg.
"24 minutes since the Fed minutes were announced, and the Federal Reserve does see aggressive hikes, providing perhaps some flexibility later in the year. And the staff are, of course, upgrading their inflation outlook. Supply-demand imbalance they continue to see. The market remained taking in its stride, basically.
Yeah. Well, first of all, I'm not sure how much the Fed is really moving this market anymore. I think a lot of this has sort of gotten away from the Fed, and some of the macroeconomic conditions are also outside the purview of the Fed right now. We'll see what happens in a couple of, whatever it is, 2.5 weeks or so, whenever they meet again here. But right now, now, this is a market, I think, kind of running on fumes and looking for a direction from anybody. They're not getting it from the Fed right now.
Lots of viewers are listening and writing in.
Are they?
They're kind, so that's the good news.
Oh, okay.
I'm talking about how, it's an easy narrative to say that the Fed is behind the curve, but maybe, in fact, they've caught up pretty quickly. Have you seen break-evens totally rolled over from some of the March peaks that we've had? You were taking a look at some of the margin compression, a bond market with yields falling in the last few days, certainly maybe already pricing in a Fed that is on its way to catching up.
But the market is a forward-looking indicator, but the consumer right here, right now, is tackling an inflation rate at 8.3%, and these numbers coming out from Nordstrom looking good for the luxury consumer, Ralph Lauren looking good for the more wealthy consumer, but on the downside, Dick's Sporting Goods, they're having to downgrade their revenue. Yeah, and I think once you kind of see the whole shakeout from the retail earnings, you'll get a better picture, I think, of what's going on in America. I'm sure the Fed's well aware of this. The question is, what can they really do about it, at least with regards to just, the sort of mechanism of rate hikes alone.
Curious about more of the deflationary impacts from some of the double ordering, the inventories, and maybe the margin compression to come from some of the discounting. But that might not play out until the second half of this year or so.
Yeah, and I mean, how much does a cyclical trade hold, right? I mean, I think at the end of the day, if people were that confident in this economy and confident in the Fed's trajectory, you would see a little bit more embrace of that. But I don't know. It seems like a lot of people are still on the sidelines. Well, it'll be interesting to see what the end of the month flows look like. But right now, a lot of flows.
No, flows? Who are you? Where is
a retail investor that is actually still buying? This is kind of what's amazing about it. The institutional money's getting out, but maybe the retail investor's still buying this dip.
Yeah, it's all Taylor.
No investment advice here. 2-year yield, though, up 2 basis points. A little bit of a flattening. This is Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. I'm Mark Crumpton. Texas Governor Greg Abbott today gave more details of the mass shooting at a school in Uvalde that killed 19 children and 2 adults. Governor Abbott said that the gunman posted on social media that he was going to shoot his grandmother, which he did, as well as target a school. At Governor Abbott's news conference, Texas Democratic gubernatorial candidate Beto O'Rourke verbally confronted the governor. The former senator has been vocal in the past about gun control. Ukraine Foreign Minister Dmytro Kuleba says peace negotiations with Russia are going, his word, nowhere. Kuleba compared Moscow's offensive in the eastern Donbas region to a World War II battle, saying, quote, when you are conducting an operation like this, you basically say no to negotiations, end quote. China's military has sent a warning to Taiwan and the United States. It conducted aerial and naval exercises around the island after President Biden said the U.S. would intervene militarily to defend Taiwan in any attack from China. The Chinese military says that U.S. actions regarding Taiwan will lead to a dangerous situation. The Food and Drug Administration says millions more cans of baby formula will be available in the U.S. in the coming months. UK-based and France-based companies are preparing infant food shipments. House lawmakers are holding a hearing today to try to get to the bottom of the shortage. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
This is Bloomberg Markets to close. And after 2:30 here in New York, let's get you caught up on what's happening in the commodity space. Looking at settlement right now of Nymex crude futures, which once again pretty much pinned right around that $110 a barrel mark, pretty much going nowhere. It's up about 0.5%, 110.37. This has really been the story now for the past 3 or 4 days, as a lot of people really try to assess not only the situation overseas, but of course domestic stockpiles as well. Some of those refined products in the latest EIA report didn't actually move as much as the market had thought, and that's a big part of the reason you're seeing a little bit of stasis in crude products. But natural gas, we got to talk about that. You're looking at $8.09 on your screen at one point on the day. Natural gas futures here in the U.S. did trade above $9 per million British thermal units. First time we've seen that going back, I believe, to 2008 here, as a lot of concerns about some of the supply or lack thereof here in the U.S. as we get into the hot and heated summer conditions here and what that could mean for prices going forward. It's been on a pretty relentless run. Seeing a pullback right now of gold futures, corn futures. You just call that flat on the day, guys.
Flat on the day. Really, inflation is front and center for us as it stands, and whether or not that be in the commodity space overall. And really, we continue to see the food inflation keeping an impact. It's notable that what we've been getting, of course, from overall the Federal Reserve minutes as well, Taylor. We've been seeing the inflation, the PCE numbers that we're anticipating later this week being upgraded by the Federal Reserve as well.
Bob Miller, of course, we know him from BlackRock, writing in, commenting, of course, on the FOMC meeting minutes. Certainly a lot of strategists coming out with some of their notes here. And I think some of the key headlines that I get from him is that after the July meeting, the Fed will become more data dependent from Maine when they talk about sort of the rate hikes underway. I think we had a great conversation with Ethan Harris, really highlighting that maybe more than 2 50s, maybe a couple of those needed, and sort of making us rethink what is neutral. Is that 2? Is it maybe actually closer to 3%?
Well, and I just want to go back just real quickly to some of the food issues, because there are a lot of sort of metrics that we can't really put on the screen because it doesn't really translate here. But when you look at like the wholesale prices of a lot of foods out there, including egg prices, chicken prices and stuff, I mean, they're going through the roof and they're continuing to go higher. There was an interesting report today about egg prices could rise an additional 21% this year, largely because of the bird flu issues. And keep in mind, we're up something like, what is it, like 40% just this year alone, 41% just in the past, 5 months. This is huge.
Huge food implications, inflationary implications.
We got to get to a rocket launch.
We got to get to a rocket launch.
Enough talk about inflation.
Yeah, get away from fundamentals. Let's go to what's happening in terms of space, because we, of course, do have yet another SpaceX launch today, targeting the afternoon launch. It's the Falcon 9 rocket, carrying small satellites for customers. And also, we understand some remains of people, cremated remains of people. This is an extraordinary launch of Falcon 9 rocket. Let's go out to our commercial space reporter, Justin Buckman. And once again, time and time again, SpaceX showing its ability to efficiently put rockets into space and bring them back down again.
Yeah, that's right. We've all become very accustomed to this process, but it is a very commercial-oriented pursuit for SpaceX. And this is one of the rare launches of late that is for customers and not themselves as the customer for Starlink. This is one that has 59 spacecraft in a rideshare configuration. So they're taking up a number of different companies, products, universities, at least 2 for NASA. So you're seeing a real diversity on this flight, and this is sort of the 5th one that they've done.
We're just going to listen in to the launch right now, Justin. Stay with us.
7, 6, 5, 4, 3, 2, 1, 0. Ignition and liftoff. More D chamber pressure nominal. Vehicles reaching downrange.
This, of course, being the launch of Transporter 5 to low Earth orbit from Space Launch Complex 40. It's over in Cape Canaveral Space Force Station in Florida. 57-minute launch window, of course, that it was. Managed to target 235.
We're now T plus 43 seconds into flight. Falcon 9 has cleared the tower.
Power and telemetry nominal.
We're currently throttling down those M1D engines in preparation for max Q, which we're expecting at T plus 1 minute and 12 seconds. For those that might be unfamiliar, max Q is when the vehicle experiences
Vehicle supersonic.
The greatest amount of aerodynamic pressure. Great view of the Space Coast.
Justin, just talk about this 5th dedicated small sat rideshare mission.
We heard that call out for max.
Yeah, this is a configuration where, SpaceX had gone out to sell a product for companies and a lot of researchers, for example, who could not afford a whole rocket, or they didn't need the whole rocket. They needed the capability to have a pricing model that was more affordable for their mission. Maybe it's a small satellite that weighs, a pound or less. And so what they did was they created this product where they essentially grouped a lot of different satellites together